and what is the outlook for the sector. Joining us on the show now we have Habeel Khorakiwala, founder chairman at Wockhardt. Good morning and welcome to the show, Mr. Khorakiwala. We did speak to you at the NDTV conclave as well, where you categorically indicated as to how resilient or how the impact could come in terms of pharma. The supply chain probably could be under pressure as well. Your first comments with regards to what Trump has said in terms of pharma exports?
Currently, there are no duties on pharma, but what will happen in future only Trump will know. I could mention that the impact, it's not easier for anyone to switch manufacturing from India or anywhere else to US. So in the short term, certainly there would be a price pressure on US consumer and healthcare provider in the US. As far as Wockhardt is concerned, we hardly have a significant presence, less than 5%. And we have planned to exit the US generic business. But many other pharma companies have a very large exposure to US business, somewhere between 30 to 50% of their revenue. And they will have to adjust themselves by maybe a little squeeze in margin, little impact also on the sales, because it may affect, but it will be very, very difficult for pharma industry to manufacture all the products in the US, because it will take several years to do that. And it is a multi-product industry, because we have so many products, so many API suppliers, and many of them are from India and China. US hardly manufacture much of the active substance. So it's going to be a fairly complicated affair, but the end result would be the US consumer and healthcare provider will have to accept a significant part of a burden. And the future of pharma industry from India, who have a very large exposure, they would certainly rethink their future strategy. And probably they would diversify the business little more away from the US.
This is big, Mr. Khorakiwala, what you're saying. Good morning, Neeraj here, because US has been that mother market for a clutch of generic companies, right? You are saying that will undergo a change, even if there are tariff agreements being reached. Let's say in the next 7 days, if there are some agreements reached, you reckon there will still be a shift out of US into other markets for generic companies?
Yeah, certainly, if you have a 30, 40, 50% of your business in the US, and with so much uncertainty for the future, and pharma is investing in research, and even for generic, and it takes roughly 2-3 years before one sees the benefit of this research. So in the pipeline, whatever is there, it will continue for a while. But certainly companies would revisit their fundamental strategy to diversify much more and maybe look at Europe and other Western markets.
Mr. Khorakiwala, just one more follow-up on this. And, nothing is cast in stone, but I would love your perspective, sir, because you started off this conversation saying it's not very easy to get up supply chains that quickly and easily, particularly in the US with the US FDA issues, etc. Do you reckon, the tariff issue from the US on pharmaceuticals is not quite there? Will it be a very high set of tariffs that could come in, because it will eventually impact inflation as well, and Donald Trump's pet theme seems to be to get interest rates down. If there is inflationary pressures because of medicine as well, that will only add to the woes.
To predict what happens,
I know it's difficult.
It's literally impossible.
But because you understand this industry, sir.
Yeah, from an industry perspective, we currently have about 40% prescription in US coming from many products manufactured in India. So it is a very, very significant impact it has on the healthcare. Secondly, it is not possible to switch from one drug to another drug for the treatment. And as I mentioned earlier, that for a significant part, it is the American consumers and healthcare provider have to rework out the insurance and other things. And anyway, US government takes care of about 50% of the coverage in the United States. So it will cost them also partly.
Mr. Korakiwala, I mean, you've been in the business during the first term administration of Trump as well. And at that point in time, there were tariff threats, which led to, probably promises of US manufacturing. However, everything was again rolled back. From what happened in Trump's first term to now, has anything changed? Because people were talking about capex, facility shifts, nothing materialized. The costs are almost 5 to 10 times higher as well. And this was something that could be impacting businesses. How would you differentiate between these two episodes?
They are entirely different. What happened in the Trump 1 and Trump 2 that everyone knows. This is a very fundamental shift. And it's not only manufacturing in US. Our competitiveness arises because of India manufacturing and overall low-cost manufacturing. Now, once you shift your production to the US, your competitiveness as an Indian company no longer is valid because your cost structure would be identical to anybody else manufacturing in US or Europe. So it asks for a very fundamental review of a business model for our industry, those who have a very significant stake in the US. So what to do in future kind of a stuff, basically.
Got it. Okay, sir, one question on Wockhardt itself. You must be in a silent period. I appreciate you can't talk much, but is business looking like being at usual and in an uptrend, or is the uncertainty currently caused by tariffs impacting you in any fashion whatsoever?
I must say we have been fortunate that we hardly have any US business, and we have already taken a position to exit it over a period of short time. So what happens in the US and the tariff, we are totally not affected. So in other words, our fundamental business model of focusing on new drug and biologicals in the emerging market is sound, and it is not going to be affected by this US-led tariff war, which is happening worldwide. However, as far as the new molecules are concerned, I don't think the business would be affected, and we would see as our products comes nearer approval.
Right. Very lastly, Mr. Korakiwala, as you mentioned, I mean, around 5 to 6% is the kind of exposure that you have in the US. You're looking to exit that. Overall, what's the kind of P&L impact that you will see overall on the back of the exit in terms of the US business?
It will be positive because we are losing money in the US today.
Okay. And to what quantum? Anything that you could tell us?
It's a little too early to tell you that, basically, but it is not profitable business, and we are losing significant amount of money in our US operation.
Right. So that's overall with regards to where exposure to US goes as well. But thank you, Mr. Korakiwala, so much for joining us on the show and sharing your views. Clearly, Neeraj, if you see in terms of Wockhardt, again, interesting point where US, which is loss-making, 5% exposure that they will be exiting. So again, it will be earnings accretive as well in terms of where business goes. But few of the other companies that we need to keep our eyes on is a Gland Pharma, Aurobindo. Both of these have nearly 50% kind of exposure to US. You have Dr. Reddy's, Zydus, both of these around 45% is the kind of exposure in terms of the US markets. Lupin, Glenmark, Sun Pharma, Cipla, these are the ones who are in double digits. So I think that this is the pack that we should be focusing on now.
Yeah, most certainly. But interesting that the two corporates which have come in this morning, Hitachi Air and Pharma, of course, we've called those kind of companies, have said that there is no impact there. The question only is, will it be the same when TCS takes the stage this week and talks about their earnings? I'm looking forward to the conversation that Sajid will have with Krithivasan.
And I think what's going to be important is, I think all of these companies are now not going to be able to give guidance, and that guidance is going to be crucial because of the uncertainty. If they do give, whether they'll be able to meet or not, but I think they will refrain from giving a guidance this time around.
Yeah, let's see. There is uncertainty for sure. But I'll tell you what we are getting in terms of views is what large brokerages are saying. We told you about what Goldman's view was. Now, let's hear out let's get in Somit, in fact, to talk about what is it that Bernstein is saying when it comes to their India strategy. Somit, good morning. Is it a note which is sounding a lot more cautious, or is it a note which is sounding a lot more optimistic?
Well, it's a note where they have actually given their portfolio ideas, in fact made some changes as well. Now in their India strategy note, Bernstein is saying that recession-proof portfolios are quite challenging to create given the current scenarios, and they're also saying that all equities have either direct or indirect risk, so one should not be influenced by any risk-free portfolio, because in equity markets there's always risk that is involved, and if one wants to invest in risk-free portfolio, then they should prefer fixed income over equity going forward, is what the brokerage is saying. Now when it comes to domestic sector wise, they're saying one should avoid exposure to IT and healthcare at this moment of time, given the fact that there is overseas exposure to both these sectors and the risk that is attached to them, and hence they have also reduced their weightage when it comes to IT and healthcare to equal weight from overweight rating that they had earlier. When it comes to sectors like financials, telecoms, parts of consumer discretionaries and utilities, these sectors are a safe bet as per Bernstein, because they show or exhibit growth and defensive characteristics. Now their portfolio of 12 stocks. Now these stocks provide healthy balance of growth, defensive characteristics and significant return potential during an economic recovery, is what the brokerage is saying. And in these 12 stocks, they have made some changes. They have added Power Grid and M&M because they believe that both these stocks will show some macro recovery as and when consumption growth comes in, and they have reduced or trimmed their exposure towards IT stocks and removed Coforge from their 12 stocks. So which are those 12 stocks that are part of Bernstein's model portfolio? Firstly, it's Infosys. Second is NTPC, followed by Power Grid and Adani Ports, L&T, ICICI Bank, SBI Life, IndusInd Bank, M&M, Avenue Supermarts, Jubilant Food and Bharti Airtel. And as for the brokerage, these stocks not only have a healthy balance sheet but could also see a strong growth as and when consumption of the macroeconomic economy recovers going forward.
Right. Thank you for getting us the details, Somit. So that's an interesting note coming in from Bernstein. If we can also have the other note that even Neeraj was talking about with regards to CLSA, because that was an interesting aspect that Lawrence also indicated. Let's just quickly pull up that one on the screens. Overall, if you see in terms of Lawrence, what he has indicated so far is that after testing the February highs, which sits just below the 200 DMA, the Nifty's advance has stalled and the price action is now below its 50 DMA as of Friday's close. We don't have the details yet, but interestingly, Neeraj, if you see in terms of the support, what he's indicating is 22,676 is where he was seeing the support, and this was followed by the early March low, which was 21,964. So these were the two levels that we were watching out for. Now, in addition to this, what he's indicated is there remains risk of further short-term weakness with pressure on the risk assets globally, and the breadth thrust is buy signal coupled with the daily momentum indicator suggests a pullback should be limited. So that's an interesting one coming in from Lawrence.
Yeah, it is. That's the CLSA view, by the way. It's not the Bernstein view, but
yes.
Interesting view from Lawrence Belanco of CLSA. But time to get in a big market voice. Nilesh Shah, MD of Kotak Mahindra Asset Management, with us on the show as well. Nilesh bhai, great having you on a day like this. Thank you so much for joining in. You and I can afford a smile, but I'm telling you, a lot of people out there are really licking their chops this morning. How bad is this uncertainty, Nilesh bhai, for risk assets pricing?
Undoubtedly, Neeraj bhai. Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability, clearly they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe, and hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Right. So can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj bhai, markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Nilesh bhai, good morning. Hiral on this side. Let's talk about history as well. I mean, tariffs have been levied by the US in the past. We did see that resulting into a recession. How are you looking at 2025 then? Do you think it'll just be a major impact in terms of lower growth and higher inflation, or it could be much more leading to recession or something like a Great Depression that we saw? I mean, is it a good comparison?
So Great Depression is unlikely to occur because today both political class as well as central bank are far more cognizant about learnings of Great Depression. To a great extent, Great Depression can be blamed on very, very tight monetary policy of central banks around the world. I'm sure they have learned from the same, and unlikely that they will allow recession to go into Great Depression without taking appropriate action. At the same time, there are equally opposite cases where levying tariff has resulted into recession in US in 1828 as well as 1930. Now, There may be
I found this on the web.
there may be people who may see that this levying tariff is appropriate from the America's point of view because of fiscal deficit, current account deficit, and debt to GDP ratio. Will it create stagflation in US where growth is lower, inflation is higher? Quite likely. That is a possibility. That will lower the global growth. If engine stops of the train, the whole train has to stop. And US is the engine of global GDP along with China and India.
So Nilesh bhai, one aspect that I'm picking up from your conversation right now is how strategically we position ourselves as a country to take advantage of it. So from an investment perspective, which are the sectors that could take advantage of this kind of a tariff war to take business from other countries into us and in turn be buying opportunities for investors?
So one, there is so much of uncertainty that there is no need to hurry to invest. In the hindsight, we may feel, oh, this was a great level to buy. But when there is a storm brewing outside, it's far better to secure yourself and then think of opportunity. Number two, clearly domestic focused sectors will stand out in this storm. Undoubtedly, India's growth can take a hit if global growth slows down, but we will still be a positive growth. We will still be one of the fastest growing major economies. So your portfolio should tilt towards domestic focused sectors rather than international focused sector. Within these sectors which could take advantage of opportunity, as India has been levied little less tariff compared to others, there could be opportunities in textiles and garment. There could be opportunities in footwear. There could be opportunities in some of the pharmaceuticals and chemical sectors and so on and so forth. But please remember, if the American demand itself comes down, then these opportunities will be back-ended, not front-ended. It's not that American buyers will straightway shift from China, Vietnam, Thailand to India. One, their demand should remain consistent. And second, we should have capacity to service them. It's all going to take time. Market does discount future, but it's likely to be more back-ended than front-ended.
Got it. Nilesh bhai, just pure domestic plays. So, I mean, you maybe put in cement out there. And I wonder if steel, for example, while it's a global play, but because of the duties having been added, that does it kind of qualify as a quasi-domestic play now versus it being a global play? I'm just trying to think, what do you think of pure domestic assets like cement, steel, and some of those commodities? Not steel, but cement for sure.
So cement undoubtedly is pure domestic sector. You can't export much of a cement. You can't import much of a cement because of bulk nature. On the steel side, undoubtedly, there is little bit of exports, little bit of imports as well. And largely, it's a domestic-driven sector. But the most important thing for us is that steel or any other commodity is a sector where tail wakes the dog. There will be excess capacity in China. Their free access to US is getting curtailed. Their free access via using countries like Vietnam to export is also getting curtailed. And that extra capacity could be used to dump in rest of the world. We are one of the largest market and also nearest to China. We'll have to be very, very proactive in levying tariffs on Chinese imports. Otherwise, it can hit a sector like steel. So in steel sector, apart from domestic growth, domestic demand, we'll have to also see how proactive our government is in levying tariff on Chinese imports.
Okay, Nilesh bhai, difficult days, but thank you so much for your wisdom. Really appreciate, and I'm sure viewers benefit from it as well. Thank you.
Thank you.
Right, that's an important market voice and some sane words of advice as well on a day which is looking rather insane because the Nifty 50 is now look like the VIX is at the highest point, by the way, and then the Nifty 50 after recovering a little bit of lost ground is still down below 22,000, so it's not looking all that great. But If you have queries, Hiral, the next show is perfect for that.
Absolutely. I mean, that's where you will be able to ask our guests and experts in terms of whether what you should be doing with the stocks that you're holding at this hour. But with that, it's a wrap on this edition of India Markets Open. Lots more lined up on NDTV Profit. Please stay tuned, and throughout the day, we will get you coverage from good and expert market voices as well.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vachrajani. And what can you say about the equity markets as they stand right now? I guess to a certain extent this was expected, but the degree of the fall, we're finally, I guess, playing catch up with the rest of the world, where last week you saw the benchmark Nifty 50 drop only about 2.5% or thereabouts. Today, the catch-up is playing out. So you have cuts of about 4% and we are trading below 22,000. Technical analysts are pointing to that 22,000 mark that is very crucial to close above. And if it does, they would take that, is the point. Let's see what our experts today have to say. But very briefly, let's take you through how the broader markets are also doing. Down about 5% for the mid-cap index, down 6% for the small-cap index. And it's carnage across the board. Even positive developments are being sold into. There's nothing really that is standing out as a winner today. In fact, some of the losers must be highlighted. And take a look at the sectoral heat map, because there is going to be red across the screen. There, of course, you have the contributors. Reliance Industries is losing the most ground, but you have on the losing end the metal index that's down about 7.6% or so, the worst hit. Understandably so, because if you think about it, if global economic growth is going to get impacted, this is a pack that is going to see the worst of the brunt, bear the worst of the brunt, right? So you have oil that is under pressure today, and over the weekend you have defense that is down about 6.5%. IT is down 5.4%. And think about it, already as of Friday, this is a group of stocks as an index that had lost about 27% from the high from December, and it has lost another 5% today. So that takes the fall quite considerably beyond that mark. What should you do? This is a question that you're probably asking. Of course, through the day today, we've been talking about how perhaps the best approach for you to take is to weather the storm. I wonder what our experts have to say. Mr. G. Chokalingam, founder and managing director of Economics Research, joining us. Brijesh Ail, head of technical and derivatives retail research at IDBI Cap, joining in. I'm going to get your views initially, both of you all. Brijesh, first on the technicals. It's gapped down. Of course, this was expected, but on the lower levels, do you deploy or do you wait for the dust to settle? Do you not be brave in this kind of a market?
Morning, Alex. So yeah, one should not be brave, but one should be reasonably buying skew the long-term perspective, because I understand that we have broken the March low, and now today we made a new low. So most probably this is again to follow up with the event which is happening globally. So my understanding is that there was a pretty good buying which we saw in the month of March, and then today, because of the panic scenario, we are again back to the demand zone. So technically, yes, 22,000 may be the level, but then I would suggest 30-40% of that capital can be employed, that in a blue chip kind of a counters, because I understand that the Q4 numbers are going to be pretty good as compared to Q3. That is one. And secondly, the Bank Nifty in today's session, irrespective of the market, it was still holding up. It may be below 50,000 mark, but then still somehow this level of 50,000 is look quite promising for the Bank Nifty. So if Bank Nifty has to rally, eventually the Nifty will also support it. So technically, I do expect a bounce. Today, I believe it's the second day. On Friday, we saw a day one. Today is a day two. Most probably follow-through selling might come, or maybe some sideways momentum will be there in day three. So this is the normal cycle, how we see for the market. So maybe it's too early to comment, but then yes, very stock-specific approach should be taken, and maybe the bounce will not be sharp, but then the low will be protected. Maybe 21,800 maximum. That is what I can say as of now from the current level.
22,000 key to monitor, right?
Yeah.
Yeah, okay. So closing above 22,000, short answer is positive, right?
Yeah, very much positive.
Okay. Mr. Chokalingam, I know we've spoken over the last 6 months consistently about the fact that valuations may have been a little bit elevated 6 months back, but now we're seeing a situation where it's corrected very sharply across the board. So if you are a long-term investor, your portfolio is bleeding at this juncture, what would you do? Do you reinforce some of the investments that you're making for the long term? Where are you advising people to deploy money?
Yeah. before I say where I would deploy, I would tell you why I would deploy. You know, I'm not going to say that the trade war is not a big issue and it's going to go away soon. It is going to stay here for long. But the biggest point is that America cannot afford to have this kind of aggressive tariff war for very long. It's somewhere soon, some compromised solution will be found out. The US market is already down 18 to 22%. Today, probably it may fall another 5%. And US economy is going to be affected very badly. The deflationary conditions are unavoidable. And, China is the maximum loser because highest tariff is on China. Where does India stand? India is in between. And India is not an export-oriented economy like South Korea, Japan. Our exports are only 10% of the total GDP. And our IT services are not governed under tariff issues. And that is much more than the goods export to US. So it is basically domestic demand driven. It will be affected. The GDP may fall 30-50 basis points, but not the way the market is panicking today. It's largely on account of panic. And as you also rightly mentioned, many stocks were overvalued for the last 1 year. That is also contributing. So now the valuations are emerging very attractive. More than 100 lakh crore is wiped out, which is 1/3 of India's nominal GDP for the current year. Now, lastly, what factor gives me a lot of confidence for the recovery, significant recovery, is that the oil price. Just look back last 20 years, whenever this kind of a major problem was there, oil price rescued Indian economy to a large extent. Now, as of now, oil price is down 30% from the 52-week high. And this is going to have a multiple effect in terms of saving your import bill, shoring up your forex reserves, improving exchange rate, reducing the inflationary condition, and thereby forcing the RBI to do reversal of interest rate cycle aggressively. So I believe this is a good day to invest. Where to invest? Look for domestic demand-driven segments like telecom, banks, which have nothing to do with America or export business. And then, you have some of the rental-based real estate businesses. So domestic pharmaceutical company, there is no point in punishing the domestic pharmaceutical company by 50%. They are not going to be affected at all. But this is a purely out of fear. Even the domestic pharmaceutical companies are getting, losing heavily. So if you look back, every block of 3 to 5 years, whenever this kind of major episode happened, Indian market always proven to be a well-creating market. So it is in your hand. Choose the right stock. Don't go after momentum stocks where the valuation comfort is not there.
Right, Mr. Choklingam, what would those right stocks be right now? Which pockets will you enter into right now?
See, I would strongly recommend stocks like FDC Limited, and oil crash will directly benefit companies like Indigo, and there are many companies which use oil derivatives like tire companies. So I would strongly recommend MRF. And in the banking space, one can consider SBI Bank, Bank of Maharashtra, Canara Bank. Bank of Maharashtra, now, it has fallen almost to 45% from the peak. It is one of the finest two banks in the country. Net NPA is just 0.2%. And it is beating the industry growth by big margin in terms of business and deposits and CASA ratio. So Canara Bank, it is available below discount to the adjusted book value. And two of its subsidiaries are going to be listed and they will unlock Canara Bank. So these are the, Canara Bank, PSU Bank, Bank of Maharashtra, SBI, so telecom companies, domestic pharma companies like FDC and PNB Housing. So these are some of the stocks, I can consider which are purely driven by domestic demand.
Mr. Choklingam, in the telecom space, would you say Bharti Airtel? And the reason I'm asking is because Reliance Industries, if I look at SOTP, is still, one would argue, much below what it has traditionally had. It's down another 5% today. It was one of the worst Nifty 50 companies on Friday. What would you do with this?
I would hold. I would, suggest a little accumulate also because, yes, petroleum business might be affected by the tariff, but then oil and gas pack itself is going down in share in the total business substantially. And yes, I agree with you. The Bharti Telecom is a pure telecom play that looks very robust at this point in time.
Okay, so that's the holistic view of what's happening in the markets and which pockets can you enter right now, seeing the significant correction in markets today. Let's move on to our first caller for the day. Anand from Andhra Pradesh is calling in. Anand, a very good morning to you. How can we help you?
A very good morning to you. Thanks for having me this opportunity.
Our pleasure, Anand.
I just want to know the stock like Sandur Manganese.
Okay.
I'm having the stocks around 440 and quantity of around 117.
Okay.
So I'm in loss of around 6,000. So I just want to know like do I need to add some more or I need to exit from this because. Few days back, it was around 480 and 500 it came. I thought of at least clearing the partial amount, booking the partial amount, but I did not done that. So just want to know, like, do I need to hold or exit?
Right. What's your time horizon like, Anand, quickly?
I have been, I am into like 1 year short term.
1 year, short term. Okay. Brijesh, I'll take your view on this one. Sandur Manganese is the counter. What are the charts indicating? Should he hold or exit?
Yeah, if it's perspectives from the 1 year point of view, then 350 is a very decent support. So I think you need to hold on to after once today's panic thing is over. You need to understand whether it sustains above 400 or not. And eventually, I believe it may go above 400 level. So I think it should be a hold.
Tata Motors is the counter that we're talking about, and remember, there's a significant update that the company sent out, JLR specifically, Jaguar Land Rover, and you will understand. Let me very quickly tell you the context. Of course, you have auto tariffs that have kicked in, but Jaguar Land Rover's said that it's going to pause exports to the US to see how this is going to pan out. And we've got a question from Srinivasan, who's writing in from Indonesia. He's got 450 shares of Tata Motors at a price of 800, and there are a lot of people like that, Mr. Chokalingam, who bought into this counter for the long term, but it's gotten beaten down, and very significantly so. At this juncture, would you say that it makes sense to add to your portfolio? Would you book the loss or would you hold on?
I would give a hold recommendation. Of course, the problems will be there, as you rightly said. It's going to be impacted. And on domestic front also, the commercial vehicles are not going to grow in double digit. And domestic front also, this PV business is not growing, enough to beat the competitor. And however, to be fair to the stock, it has crashed a lot. And I would say that it's a long-term hold because in 1 to 2 years, it can definitely has a potential to come back. The tariff war also would settle down in a year or so. So therefore, it's a long-term hold. I would not recommend a buy. Maybe by any chance it falls another 5-10%, then one can consider buying the stock for long term.
And this is a stock that I will remind you fell to double digit at one point of time within the last 5 years. And at that point, when it did recover, it ended up being in that particular year, I think it was 2023, if I'm not mistaken, the best performing Nifty 50 stock. You look at that rally, right? So from 2023 start to 2024, the kind of run that it had was very significant. The low point in the last 5 years was 67 or thereabouts. All right, Srini is calling us from Chennai, asking about a stock that is down 10%, if I'm not mistaken, Wockhardt. There you go. Srini, good morning. How can we help you today?
Good morning, Alex. This is the first time I am going for stock without analyzing that because I was trying some technical things. And but unfortunately, I don't have any information about this particular stock, Wockhardt Pharma, WOCK Pharma.
Yes.
That's what I mean. And I think I'm close to like 43,000 loss, but I can hold for 6 months also. But do you think it is worth holding it or adding something after it goes down further, something like that? Can you guide me on the company aspect, please? Because I seriously couldn't find anything online.
Okay, so what you're trying to look for, no, that's perfectly fine. I understand it. But Srini, you've gotten into what, let me understand your question. You've gotten into a trading situation, but you want to know about the fundamentals because you have now pushed your holding period down the line. You want to hold for longer, right?
Exactly.
Okay. So I will invite you to have a look at the conversation that we had with Mr. Habil Korakiwala. It's going to be available on the YouTube channel. We spoke with him earlier today, and he was speaking about the fact that the US consumer is going to have to bear the brunt of higher tariffs if they do come through on pharmaceuticals. At this juncture, there is no such announcement. But I'm sure that Mr. Chokalingam tracks this stock. Mr. Chokalingam, would you hold on to Wockhardt? Would you double down on your investment? The holding period that Srini has is relatively short term, I understand. But this is a situation where he's not in a hurry to sell and he's willing to extend his time horizon if he has to. Is this the right stock to hold on to?
For last 3 years, it has at a consolidated level, it is making losses. On trailing basis also, it is making losses. And again, Mr. Trump said he will come back on, the pharmaceutical industry. We don't know at this point in time what kind of pain will be there. I believe there will be little compromise because US market also crashed and, world markets are crashing. However, if a given option, I would prefer a domestic demand-driven pharmaceutical stock like FDC Limited. So if I'm holding Wockhardt, I would sell and buy FDC. Just a compliance disclosure, we have already invested in FDC. This company draws 82% of the total business from the domestic market, and stock also crashed, and it has got a very good balance sheet, a lot of free cash, and excellent management. So I would prefer a stock like this to Wockhardt.
Okay, Mr. Chockalingam got your point there. Sell Wockhardt and buy FTC is what he's saying right now, and he prefers domestic play where pharmaceuticals is concerned. Moving on to our next caller, Geeta is calling in from Tamil Nadu. Geeta, a very good morning to you. How can we help you?
Yeah, very good morning to all of you.
Good morning. Go ahead with your query.
I'm a very big fan of Mr. Chockalingam.
Okay, Geeta, I hope Mr. Chockalingam is hearing that.
Okay.
Yeah.
My question is about Infosys.
Okay.
Actually, I bought Infosys around 1,350 3 to 4 years back during the COVID downfall.
Right.
I still hold it. It's a long-term question. At this current today's market price, is it advisable to put a few portion of my investment in Infi? And another thing is it Infi or TCS today?
Okay, got your query, Geeta. Mr. Chockalingam, I'll come to you. There's also a query on Wipro that I have on WhatsApp. The person has purchased at 140 at 288 per share, and he is holding 140 shares and wants to know, should he accumulate or buy at the current level? So you have 3 stocks right now: Infosys, TCS, as well as Wipro. What's the view like, and what's the overall holistic view on the Nifty IT as well?
First of all, thanks for to your viewer for kind words. Large cap stocks I was a little negative, but after a recent massive fall, I would say that one should hold on to stocks like Wipro, Infi, TCS. And if one has to buy, I would recommend strongly Infosys today. Why? Yes, for the current fiscal, the large cap stocks are not going to post any meaningful growth. But what Mr. Trump is doing is going to strengthen the US economy enormously in 1 to 2 years. There is no doubt. It would streamline, restructure the economy and improve its economic prospects. And that is ultimately going to be recognized, and that is ultimately going to help IT services companies, because US economy will come back to strong growth and discretionary spend will increase. So the medium to long-term prospects for large IT stocks look very good. And stock also Infi fallen us by about 31%, and it's a very good price to enter. And tactically also, Infosys, whenever it crashed like this in the last 10 years, it bounced back. Management also rewarded the shareholders enormously. So considering all that, I would give a buy call on Infi today.
Okay. Incidentally, Mr. Chockalingam, we have another question on persistent systems, since it's in the IT pack itself, and we just spoke about IT. Let's complete the circle, because we've got Dasarathi, who's writing in from Vijayawada, who's holding persistent 20 shares at a price of 4126. He's still making profit right now. Should he hold or exit is the question. He says that he's a long-term investor.
One can hold. Valuation is stretched, persistent, but after such a steep fall, it looks a little attractive for medium to long term, and its performance has been far excellent. So steep correction makes it a little attractive for medium to long term.
Okay, all right. We've got a caller from Hyderabad. Raj is calling us. Good morning, Raj. How can we help you today?
Yeah. Good morning to the panel members there. I've been recently seeing your program, and it's very interesting and very informative for people like me.
I'm glad to hear that.
I have a small query.
Yes, please.
I have a small query. I have some money to invest.
Okay.
I'm a senior citizen, and I'm looking at 1 to 2 years. BPCL is what I have targeted. So can you help me at what price I can buy BPCL for a 1 to 2 years perspective or for a long term?
Okay. Raj, while I will take your question, I just want to understand, you say that you're a senior citizen. Do you own any other equity, any other shares?
I have BPCL some shares.
Okay. And anything else in your portfolio?
No, I don't have any other thing in my portfolio.
Okay. And just very quickly, if I were to understand, out of your entire portfolio that you've kept aside for your long term, do you have a certain amount in equity that you've invested, either, I'm guessing, through mutual funds, if that is an option?
No mutual funds. I have fixed deposits and PPF.
Okay.
And this equity will be around 20-25% of my total investment portfolio.
And that's only BPCL?
I'm looking at dividends also, where it will help me for regular income and appreciation also over a long term.
Understood. Okay. So with
and
that,
the safety of the product also, it being a government-owned company, the risk being slightly medium or less.
Okay. Having said that, it's always a good idea to have a portfolio of stocks so that you can reduce the concentration risk, especially in a market that can see across the board cuts, right? But Mr. Choklingam, BPCL specifically, is this the right time to add? And what else would you add? You've already given your pockets where you would prefer deployment over the long term. But BPCL, the question mark is whether or not the benefits of lower crude will translate into gains for BPCL. It hasn't in the past entirely, right? That's the question. So would you buy right now?
Yeah, you are absolutely right. Most of these companies, they don't gain much when oil price crashes, and they don't, gain anything when oil price goes up. And the profits also very inconsistent for all these companies. So tactically, yes, 15-20% upside is possible because it has already beaten down a lot. But for conservative investments, I would prefer stocks like State Bank of India, because as I mentioned earlier, there are very few sectors which have double-digit growth prospects, and banking is one of them. Now SBI is trading around 1x book value, and the second stock from the dividend point of view, one can consider Coal India better than the oil and gas stocks, because Coal India gives you excellent dividend, and in FY25 they missed the growth in coal dispatches, but there is a lot of pressure for Coal India to increase the coal output in FY26. Not only that, non-coal based minerals, they are trying their best to diversify in a big way. So all these would augur well for Coal India. A third growth stock would be CDSL. So I would prefer CDSL and SBI as a growth stock, and the Coal India from the dividend perspective.
Okay, the next query is from Telangana. Yeluri is writing in. She is holding 800 odd shares of Larsen and Toubro, bought at 3,500 a piece, and she's sitting on a significant loss of around 3.6 lakh rupees right now, and wants to know whether to hold or exit the counter right now. Brijesh, I'll come to you. What are the charts indicating? Should the person hold to see some recovery in the losses, or should exit at this given point of time?
I think the hold should be the view, because the capital goods space is looking good, and with the recent correction, I think they are coming back to the demand zone. So for the specifically this L&T 3,000 close to 3,100 level, I think this is the demand zone. So that is, maybe today it is broken, but then I believe once it sustains about 3,100, it will be back in action. So it's a pretty good level to make a re-entry, and if everything goes right, the bounce back will be close to 3,450, 3,500. So it's a buying opportunity. I think one should hold, and if possible, one should also look for to do the averaging.
So either hold or average out is the view coming in on Larsen and Toubro. Our next caller, Kunal, is calling in from Mumbai. Kunal, a very good morning to you. I believe you have a query on Bajaj Finserv.
That's right. Good morning. I hold 10 shares worth, I bought it at 15.33. I just want to know whether to buy more or shall I hold it?
Okay, I'll take your query up with Brijesh. Brijesh, what's the chart indicating for something like a Bajaj Finserv? Should he continue to hold, add more?
Hold and buy. Even the buying is suggested, because we have a view of 2,200 plus. So maybe in next couple of weeks, we should be seeing Bajaj Finserv back to 2,200, close to 2,200 level. So that's a new level which we are talking about. So it's definitely a buy kind of a trigger. Even in today's market, it's marginally down. So I think it's an opportunity, and he can definitely hold on to the long trades.
So you said hold and not add, right? Or did you say add?
Yeah, we can add also because 22, another 400 points we are talking from the current level. So definitely somebody wants to take the fresh bet is also advisable.
Okay, all right. Hudko, I'm coming to Mr. Choklingam on this one. Rohit is a long-term investor. He's got 1,000 shares of Hudko at a price of 280. He's wondering whether to average his holding right now because stock is down 5% in trade today and he's incurring a loss as well. What would you say?
One can hold it, but I would not recommend a buy because even at this price, in terms of price to book value, it is slightly stretched in terms of valuation.
All right. Well, Brijesh, we're told that you have to go now. So thank you so much for joining us and taking out the time and speaking with us at NDTV Profit. With that, it's time to slip into a very short break. We'll be right back answering all your queries on the other side. Stay tuned.
That's huge. That is a biggie. It's out of there.
गोल्ड प्लस क्लियर ग्लास, कार हो या नियर, सब कुछ दिखे क्लियर।
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Hi, welcome back. You're watching Ask Profit. It's a tough day, no doubt about it, and the markets are bearing the brunt of everything that's happening globally. The tariff storm has caught up with the Indian equity markets. Of course, to a certain extent, some might say that we're playing catch up. Joining us on this side of the show is Ajit Mishra, who's a Senior Vice President Research at Religare Broking. Ajit, thanks so much for joining us this morning. Just a quick view from you as well. We were speaking with Brijesh, and earlier today we were speaking with Kush as well, and they were both talking about 21,800 on the Nifty level to look at in terms of support, and 22,000 above closing would be taken as a big positive today. Would you concur?
Good morning, Alex. So, Alex, we have retested this, last month low, around 21,964 was the low which Nifty had made. On the closing basis, definitely is going to be critical where we close today. Let's say if we manage to hold 22,000 mark, then probably we can see some, recovery, or I would say that attempt to fill this gap which we have experienced in the market. But having said that, the way we have retested this level, we need to watch out for decisive sign of recovery before going aggressive longs in the index or otherwise also. So for a time being now, I would rather suggest maintaining a cautious approach, means trading through option strategies instead of like looking for long trades, naked long trades in the index, be it on long side or short side.
All right, so that's the view coming in with respect to where markets are concerned. But Ajit, the next question is also for you. Session is writing in, he's saying he had 5 to 6 lakhs amount waiting to buy some stocks since Jan market is falling. Can you suggest some stocks? But right now he's saying for 6 months perspective he wants to deploy around 1 lakh rupees. Mr. Chockalingam has already given his picks already in the start of the show, saying that these are the picks that he finds attractive. But what are your picks according to you in the next 6 months that are looking attractive on the charts right now?
Right, Mahima. So, see, the best thing which one can do is to focus on sectors which are showing resilience or relatively higher strength. So, banking and financial one is definitely a pack wherein we are seeing noticeable, outperformance throughout this correction. So, ICICI, HDFC, Kotak from the private banking basket is something that definitely one can look at. Then after like this, underperformance, FMCG selectively, we are seeing some sign of reversal. So here also one can start accumulating stocks like, Colgate and Marico. And apart from that, from the cement space, Ultratech looks very strong on charts. So these are a few names which one can look to accumulate in the current market scenario.
Okay. Kushal is calling us from Bengaluru. Hi Kushal, good morning. How can we help you today?
Yes, sir. Good morning. So I'm planning to purchase Genus Power share.
Okay.
So is it the right time to enter into the stock?
What is the time frame that you have in mind, Kushal?
As their order book is excellent for about 3 years. So my plan is up until 3 to 5 years. It's a long term.
3 to 5 years. Okay. Mr. Chockalingam, have you studied this company? One, how do you look at, and what are the parameters that you would look at here? Would you buy into this?
Yeah, I have studied for very long this smart meter business. After the price crash, yes, for 3 to 5 year time frame, one can buy. But I would not go very aggressive on this because a lot of big players are also proposing to get into this smart meter business after seeing the great potential. But yes, valuation is slightly stretched after fall, but still it's a good buy for a period of minimum 2 to 3 years.
Okay, so good buy for the next 2 to 3 years is the view coming in on Genus Powers. All right, the next counter that we're talking about is HG Infra. Do we have the name of the person? Okay, Sudhanshu is writing in. He wants to know whether from a longer term perspective, is HG Infra something that is looking attractive right now or not? Mr. Chockalingam, I'll stick with you. What's the view like?
Yeah, I have studied it. For long term at current price, it looks a good stock to buy.
Okay, so that's the view coming in on HG Infra. We don't have the next call. Okay.
Actually, there were a couple of others as well. Mr. Chockalingam, he is also considering Data Patterns and Titagar Rail. So between HG Infra, Data Patterns and Titagar Rail, based on current valuations, which one would you pick?
Data Pattern, I have not updated myself recently.
Okay.
But the railway stock I would avoid because, as I have been saying, FY26 budget outlays already proposed and which is not favorable to the railway stocks. So only in FY27 one can go for increase in the capex from the government. So therefore, I would avoid railway stocks even now and go for growth-oriented sectors like banking.
Okay, so that's the view coming in. So, but between the three, HG Infra is your preferred pick, right?
Yes, one can buy HG Infra.
All right, okay. All right, our next caller, Shailja, is calling in from Hyderabad. A very good morning to you, Shailja. How can we help you?
Yeah, hi, Mahima. Good morning.
Good morning.
To you and Alex.
Good morning.
I have a query on Bharat Forge. I have 10 shares at 1160.
Right.
So, I want to know fundamental view and whether I can add more to this stock.
All right, Shailja, I can feel
Because
the
it's
pain of
around,
markets falling in your voice.
Yeah, it's 8% fall.
Yeah, I can understand. All right, I'll take your query up with Mr. Chockalingam. Mr. Chockalingam, what's the view like for something like a Bharat Forge?
I would say hold. Definitely it is going to be impacted by the tariff war. So as I said earlier, I have a bias for domestic demand-driven sectors and companies. So therefore, I would not buy now, but definitely it's a great company. It has done extremely well over the last 2 decades. It will definitely bounce back, but it might take time. So therefore, I would give just a hold call on Bharat Forge.
Okay, so that's the view coming in on Bharat Forge. Ashish is writing in from Telangana and he wants to have a view on Elecon Engineering. And he wants to know whether he should enter the counter right now or not. Ajit, I'll come to you on this one. What are the charts indicating for something like an Elecon Engineering?
So Alcon, Mahima, we have seen decent correction. The stock has retraced to its major averages, long-term averages on the weekly chart. And today also, after the initial downtick, we are seeing an attempt of recovery. So it seems like that probably we can see some consolidation before any meaningful, respite. But if the view is, let's say, from medium to long term, definitely we can start accumulating at current levels. And I believe that 350 is the base, basically, where we have multiple supports. So that should be a stop loss in considering the current market volatility, and upside around 500, 520. That should be his positional target.
On Elecon Engineering, Trent. Okay, now it's not every day, of course, that you see a stock like this drop the way that it has, and I'm pretty sure that Mahima, while she thought that the update that they had on the quarterly basis was negative, she did not anticipate, and neither did a lot of investors anticipate, a 17% downtick on the stock.
In fact, it did touch an intraday low of almost 19%.
Well, there you
which
go.
Which is not normal for a Nifty 50 stock to fall like that.
Not at all. But we've seen a few instances of that this year, not least of which was IndusInd Bank, but for very different reasons.
Absolutely.
Trent, if you're talking about a 28% uptick, Mr. Choklingam, on revenues, where the expectation was for a 35% plus increase in revenues in the fourth quarter, take that on one end, and on the other end you have a very significant store count addition in the fourth quarter, particularly on the Zudio stores. They have added double of, or rather more than half of the store additions in the full year have been in the fourth quarter. So specifically on this, we've got Jinsen who's asking, considering the kind of downtick that you've seen in the stock, is this the right time to buy the stock?
I would suggest one can still hold on. In case market weakness corrects, it can even fall further. It's a great company, no doubt, but the valuation was also great. So that is the reason the stock has corrected day like this quite badly. And second, many of our analysts know that the physical store business, there is a potential threat, and some of the companies, they started losing the growth momentum. So I don't know when Trend will get impacted by this structural change happening, the business shifting away from the physical store to online. So therefore, I would suggest a hold on in case market weakness continues and the stock falls another 5-10%, then one can consider a Trend.
Right. But do you think valuations are now looking attractive? Because even after a 16% fall right now, I don't think the valuations still look cheap.
You are absolutely right. So that is the reason I am saying that, if at least falls 5-10%, one can consider. Of course, we also go wrong on Trend because historically, last 5-10 years, it has been commanding huge premium. So even after 5-10%, it will not be very cheap, but then one can consider considering the historical premium it has been enjoying. So I would wait for 5-10% correction.
All right. Okay. That's the view coming in on Trent. Our next caller, Suman, is calling in from Bengaluru. Suman, a very good morning to you. How can we help you?
Yeah. Hi, Mahima. Good morning. So my check is on the Ashoka Buildcon. I wanted to buy. So is it a good time to buy or not?
All right. Got your query, Suman. All right. I'll take this up with Ajit. Ajit, what are the charts indicating for something like an Ashoka Buildcon?
So Mahima, almost 50% of correction from the record highs, and if you see the last 2-3 months of price action, it seems like that there's a base formation going on around 160 area. So she can start accumulating at current levels, and if the view is, let's say, for short term, considering the market volatility, the stop should be at 155. In the next leg of the up move, let's say once we complete this base formation, then probably around 240 is something that the stock might attempt. So the risk reward is favorable with 2 to 3 years at least of time horizon. She can start accumulating.
All right. Another stock that is a retail investor favorite, and that has dropped from peak levels of over 80. I'm talking about Suzlon, and we've got Sagar HR, who's bought at levels of 64. The stock is currently trading at 51, 52, and it has lost significant ground today as well. And so, Mr. Choklingam is not bought at elevated levels, at least not where the stock was about 6 months back. But it's still something that has given up from his level. So would you say he's wondering whether to buy the dip or to hold? What's the view?
I would give hold. Even after the such a major fall, the stock valuation is highly stretched. And let us not forget the fact that, in the renewable energy space, tremendous structural change is happening. How it happened in the microfinance, small finance, similar thing is happening in the renewable space. A lot of big players have entered and they have become very active. So valuation-wise, it is stretched. But I would go wrong on my call only if it becomes a target of any possible takeover. Otherwise, based on the valuation per se, I would say that somewhere around 35-40 would be the fair price for the stock.
All right, so that's the view coming in on Suzlon.
Wow, 35-40 is the fair price.
Yeah.
Okay, there you go. If you thought that there has been a correction in the valuations, well,
so I think book your profits then right now.
Well,
whosoever is bought it at the correct levels.
So just want to clarify that, Mr. Chokalingam, before we go forward, because if you say that the fair value is 35-40, does that mean that somebody is holding at 64 should book?
See, what happens, I'm not trying to escape, but we also learned from these last 2 years, a lot of tactical upside happens because about 21 crore new investors, out of which 10 crore young investors have come. And sorry to say that many people do not look at the funda just because, stock is in low double digit, there's an entire group to chase and buy. So therefore, if somebody is losing, one can wait. As I said, the consolidation can happen. I'm not forecasting that Suzlon will be taken over, but such things happen, it would be positive. Otherwise, if you look at the earning per share on a consolidated basis, valuation is stretched. And let us not forget the history that the stock was trading up to 440 about 10 years ago. And from there, all the way, it has come down to even 7 rupees. So anything is possible. Ultimately, the market is smart. The fundamentals will drive the market ultimately. But to short term, to medium term, fundamentals do fail. So it may happen. That is a risk to my view for Suzlon.
All right, so that's the view coming in on Suzlon and a very comprehensive view. So thanks for that, Mr. Chokalingam. Our next caller, Venkat, is calling in from Hyderabad. A very good morning to you, Venkat. How can we help you? Okay, I think we've lost him. All right, we have his query though. He's holding Electra Green Tech 500 shares at 1500 a piece. He's sitting on a significant loss right now of around 2 lakh rupees. Ajit, I'll take this up with you. What should he do next? Should he continue to hold, wait for the stock to recover, or should he book the losses?
So Mahima, here also we have seen decent retracement from the record highs level, and this zone close to around 950, 970 is the area basically where the stock made a previous swing low. We have retested that mark off late, and again we are seeing attempt of recovery. So in my suggestion, he can stay put with 950 as a closing stop loss, and around 1250, 1300 zone, he should try to reduce his position. Because it's highly volatile, and for any stability in the counter, we need decisive close above 1400 mark for a week or two. Then only we can see the reversal in the trend.
Okay, so Darshan has got a question. He's writing in from Karnataka and he's shared his entire portfolio. Darshan, unfortunately, we can't discuss portfolios because we'll end up taking only a few questions. But from the list of shares that you've shared with me, Tata Power is what I'll focus on. You've got 150 shares bought at levels of 230. On the fundamentals, Mr. Chokalingam, would you hold on to this as part of a portfolio?
Definitely. I mean, still valuation is a little stretch, but then stock has fallen a lot, and management background is too good, and the company is also planning a lot of expansion into renewable energy. So therefore, I would give a hold, and in case it stock falls 5-10%, then it can become attractive buy as well.
Okay, so that's the view coming in on Tata Power. Our next query is on BSC. The person, Shanmukha is asking whether these are the right levels to enter into something like a BSC or wait for this week to end. Ajit, I'll come to you again. What's the view like on something like a BSC? What are the charts indicating?
So Mahima, still we are seeing relatively high strength because the way the stock rebounded after making a low around 3600 mark, we almost tested the record high areas. Today with the market correction, again we are seeing a dip, but still it's maintaining above its all the major averages, including the short one. So basis that one can continue to hold the longs with 4800 as a closing stop loss. Obviously there could be some consolidation after this recent recovery. But broadly, the tone looks positive, and upside around 5800, 6000, the record high area can be the zone where one can look to. book at least partial profits.
Okay. We've got our next caller, Anish from Hyderabad. Anish, good morning. How can we help you today?
Yeah, hi. I'm actually having a stocks of IRFC around 1200, which I bought it around at 180. So should I hold or should I invest more in a couple of different stocks or anything?
Okay, help me understand what the thesis was. Did you buy it for the long term?
Yes, I bought it for long term for at least 5 years.
For 5 years. So, all right. Mr. Choklingam, I know that you said that you're not favoring railway companies, but here we're talking about a railway financier. Do you have a different view? Would you hold on to something like this?
Yeah, it's a lending business. Even now it is slightly stretched, but then, for 3 to 5 years, definitely it will come back to solid growth mode. Since because the capex is not happening from the government, it may remain laggard for 1 year, but then if somebody is having a week for 1 to 3 years, definitely it can come back to solid growth mode. So therefore, I would give hold, but I would recommend a buy in case it falls around 100 rupees.
Okay, Chris is holding around 5,600 shares of Geo Finance, bought at 252 a piece, and he wants to know whether he should average or hold at the current rate. Ajit, what are the charts indicating?
So, Mahima, it's a very volatile stock. We all know that because almost, it made a new record low. And again, we are seeing that during this market correction, it's almost, hovering around that area. I would rather suggest him to hold, not to add at present. In fact, he can add once the stock crosses 240 mark. Because in that case, there will be a clarity that yes, the stock has started forming higher lows. And then around 265 to 280 is something that the stock might test. So as of now, it's a hold with 200 as a closing stop loss.
So that's a specific view on Geo Financial Services. So today is an important day, of course, to get views from the who's who in the markets, and all of this should give you some perspective. And joining me now is Nischal Maheshwari, and we were looking forward to speaking to him so that we can get his perspective on how to approach the current scenario. Nischal, thanks so much for taking the time on what I'm sure is a very busy day for you as well, but I think my viewers will benefit from your insight. At this juncture, how would you approach this? Because would you agree that to a certain extent we've got the flu finally, the Indian equity markets? And from a long-term perspective though, do we still have the confidence that you continue to hold? Now is not the moment to sell, but would you double down and invest more in the stocks that you hold?
Thanks, Alex, for having me. Yes, it's been a turbulent morning, basically. Yes. At the moment, I think the best thing to do is just stay away from the market. There is no point on catching a falling knife because you really don't know how the other countries are going to react. China has already done it. Most countries, smaller ones, basically have all come to the table to negotiate. So let's see how all this pans out. I think it's best to avoid for next 1.5 weeks. See how all these things pan out. Maybe the Nifty will go to whatever levels. Nobody can predict that. So best to avoid. There is no hurry to buy in this market.
To buy, but then would you avoid selling as well, Nischal? Because the point is that, and here I'm talking about something like a trend. Okay, so there was a business update that perhaps was not as rosy as some would have liked. But 28% growth in the revenue for the fourth quarter was expected of over 35%. It's a stock that is down 17%. It's a Nifty 50 stock. Do you avoid selling as well is a question.
So it depends upon basically whether it's been selling because there has been some margin calls. If there is no margin call, I don't think so at this point. Basically, not only trend, but anything. There is no point in selling in this kind of a market. The markets are very low. I think some sane sense is going to come back to this market and maybe you will get better rates basically to sell. So I totally agree with you basically that there is no point on actually going out and panicking and selling at these levels. Yes, you may still see lower levels than this. That's what I'm saying. I'm not sure basically how low it can go, but there is no need to panic at the moment because I'm saying, yes, conditions are bad. And but what my thought remains to be that cooler heads will come to the table and things are going to work out not at pre-tariff levels, but definitely somewhere in between the pre-tariff and the level of tariffs which the Trump administration has put. So across the world, I see maybe there is going to be some giveaway, mostly a 10%, which was the base level of tariff, and some percentage above that. But then it is much better than what we are today. So that's why I'm saying basically just cool off and see for the next 2 weeks how this market comes, and then only whether you want to buy or sell, then only take a call.
Okay, and Mr. Maheshwari, if you wait for 2 weeks and we see a significant dip in the next 2 weeks as well, any counters that you would want to enter into and see that these counters are now looking attractive where valuations are concerned? And will those bets be domestic play bets?
Surely, I think last week itself, basically, I think it has become clear that you have to focus on the domestic companies for the at least next 2 quarters. And beyond the next 2 quarters also, I believe the Indian economy is going to revive. I think the government is taking enough measures, whether it is the rate cuts. I expect another rate cut to happen in another couple of days. Then there has been an income tax cut. So I think all those things, measures which the government is doing basically will show up in the second half of the current financial year. So that's why you are saying basically that at least for the next 2 quarters, wait out, and thereafter basically we are going to see earnings coming back, maybe some amount of earning upgrades also happen in the second half. So better economic sense will prevail.
Nischal, if we're talking about, and your point is well made, right? Because if you're talking about announcements that the Chinese government is already making to focus on domestic growth, you'll have European leaders that are talking about, hey, don't invest in the US, questioning whether or not it makes sense and saying double down on investments in Europe. So if all of these geographies, and I take your point to say that perhaps a common ground will be found on trade, but once bitten, twice shy. If you're dealing with the US administration, you'll have a lot of administrations around the world that will double down on domestic growth. And so from that perspective, for the Indian investor, what areas do you see? For example, financials have been relatively resilient, and in order for domestic to grow, you need financials. Similarly, you would talk about cap goods, you would talk about power. What are the places that you would look at and say there is value here?
So I think financials definitely as a sector basically has got good value, and it's not performed for the last 3-4 years. So I think the outlook seems to be good for the financials. If we have another rate cut happening, which is most likely to happen, I think it is going to be favorable for the whole financial sector. So financials is one. I would for the moment still wait out to see whether the consumption is coming back or not. Because there I think with these kind of numbers, there are question marks. FMCG, it's a very mixed bag. There are a couple of companies saying yes, others are saying no. So really, I think one should wait out for the consumption sector. Government spending is another definite thing happening. Government spent around 12 lakh crores last year. I think similar number is happening this year also. So I think there you should be looking at industries like cement. Steel is a global commodity, so avoid it for the moment because you don't know if there is a tariff war between China and US, so China has to find newer markets to dump their steel. So India could be one of them. So avoid steel or metals for the moment, but cement is one basically definitely you should look at. The other ones basically capital goods to an extent, but capital good one has to be very clear saying that it's not the companies which are exporting because India has a large capital good export to the US also. So one should be very careful where we are investing. Power, capital goods, these are the other sectors basically which I look at it. And then there is consumer tourism. I think domestic consumer tourism, whether it is hotels, airlines, I think these are the sectors basically one should focus on.
Nischal, and I understand that talking about individual names is tough, but I would still encourage you not to give recommendations, but within the packs that you've looked at on a relative basis, stocks that are already looking much more attractive, and also just to follow up on the spots that you've seen that could emerge as pockets of value. I just want to understand your own assessment of the earnings scenario going forward. What is your base case assumption, though it's very difficult to make that assumption right now?
So I think 25, as we have seen, basically would end up with a low single-digit earnings growth. I think in this kind of a background, you will first see earnings cut happening for 26. Because still, I think the earnings growth, which is being projected, is I think 15 to 16% by most analysts. So I think that would come down to a high single digit number for FY16, FY26. And in the second half of the year, as I was telling you, once more earnings visibility improves, basically it may go up to low single teens, low double digit number basically. So that's the way basically which I expect. So a 10 to 12% kind of a growth in 26, 8 to 9% for 25. That is the way basically I see earnings happening. But earnings will get cut first and thereafter get revived. So I'm saying that kind of pain we have to still go through as far as the domestic market is concerned.
Okay. Nishal, thanks so much as always for taking the time and really appreciate the time that you've spent with us today.
Welcome.
All right. We're completely out of time in this edition of Ask Profit. Hopefully this conversation over the last 1 hour has helped you and given you some perspective. We've got Know Your Company up next, so do stay tuned. And this is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Maybe real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
Hello and welcome. You're seeing pressure in markets, and what we've therefore tried to do on Know Your Company today is something which is more inward facing, more looking at India and the possible growth with regard to power, because that may not change significantly, even though there are risks, but may not change significantly due to tariffs. And therefore we're looking at a Nifty 50 company, Power Grid Corporation, and we're going to quickly try to break this one down. Power Grid, what does it do? It's India's largest electric power transmission company. It has a 70+% market share in power transmission. And what is power transmission? I'll probably try to break that one down as well. One is the power generation, which say happens in a particular place. Thereafter, the power consumption is happening in quite another place, whether that's a manufacturing facility on the outskirts of a particular city or a metro, or it's within a city where you and me consume power, right? So therefore, transporting that power over grid lines from the place in which it is generated to the place in which it is utilized is essentially what Power Grid does. And there are various places along the way where power transmission will happen and go through these power grid lines, thereafter landing up with the final consumer. So that's what Power Grid Corporation does. What they also have is they command an 80+% of grid capacity of India. So the entire grid capacity, 80% of that is run by Power Grid, and then 20% are by some of the smaller players. In fact, less than 20%, 84% absolutely precisely is the power grid capacity that Power Grid has. And therefore, this is a large chunk of India in terms of coverage as well as in terms of grid lines, and therefore very difficult to get power from one place to another without involving a company like Power Grid. That's essentially what I'm trying to underline. 70% of India's power goes through the Power Grid Corporation grid, and 84% of India's interstate lines are run by Power Grid. Now, in terms of the capex plans, because grid capacity needs continuous expansion as well as needs upgradation. So you have 23,000 crore of capex in FY25, and this is important and relevant, and we'll come to why it is important and relevant as well. But for the moment, this is the kind of capex plan that's being put up. FY26, there is a 28,000 crore capex plan, and FY27, there's a 35,000 crore capex plan. Combined, the capex plan is closer to 90,000 crore. And we're talking about a company with a sub 3 lakh crore market cap, doing a 90,000 crore capex over the next 3 years. This is why it becomes extremely relevant to know this particular metric. Now, in terms of funding its capex, it does it in two fashion. Of course, internal cash flows and resources is what it uses to push capex out, but also debt financing in a big fashion. And debt financing, you will see in terms of the balance sheet debt, is sizable in that sense. So something you may want to keep in mind, because these are large capex plans, right? Now, in terms of how it runs its business, the returns for Power Grid are regulated, because you have there's a framework that is in place, and regulatory authorities determine the rate at which power transport or transmission actually happens. This is largely done on the basis of a cost structure which they keep in mind. They also consider debt, and they look at the debt raise, and they consider the ROE, the final ROE to Power Grid, which in some form or shape they try to cap. So based on the texture of the market as well as the industry, they look at anything between 14.5% to 15.5% in terms of ROEs when they determine tariffs, and thereafter they lease these lines, and a tariff is actually paid out to Power Grid. So they follow this framework to ensure that Power Grid earns fair returns, and at the same time there's no cost burden or disproportionate cost burden saddled on the final consumer. So that kind of blend is what regulators keep in mind when they determine tariffs. Now, that's essentially how the business is run and the structure works. We have spoken with Rupesh Sankhe of Elara Capital, who tracks cap goods and power. And he's given us his views with regard to power grid in particular, and we've discussed some risks with him, which we will, or rather we'll speak with him and we'll highlight some of those risks to you, and we'll try and ask him and quiz him on some of the risks. But let's quickly talk about the metrics that we need to look for in terms of a company like Power Grid. First off, we'll look at the income statement, how well that is growing and how that has done over the last 3 to 4 years. We'll look at the balance sheet. This will be key because large capex plans, mind you, just want a quick refresh that as well. The order backlog, how large in terms of orders and capex is like, and how much is the work in hand, and what is the execution looking like. In terms of cash flows then, how does cash flow stack up? We'll also look at how return ratios are playing out. We're looking at shareholding, and we'll look at street cred and street coverage, and thereafter derive a rating. So over the next maybe 10 minutes, we'll try to break this down. Mihika Barve joining me for this one. Mihika, it's been a while since we had you on KYC, but why don't you help us with the income statement?
Yeah. Let's start off with the income statements. Now, in terms of your 9-month FY25 numbers, your revenue stood around 33,000 crores, EBITDA around 28,800 odd crores, margins stand at 86.1%, and net profit stands around 11,300 crores. Now, in the 9 months FY25, and the kind of growth you've seen on a year-on-year basis, we have seen a slight degrowth. Revenue is down 1%, EBITDA down 3%, margins have come off by 190 basis points, and net profit has remained flat, biased to the negative side. However, it's key to note that the company, the way it recognizes revenues is how much of its order backlog it's recognizing and how much of its capex it's capitalizing. So we could see more of the capitalization done in Q4. But when you look at the 3-year CAGR, it's done pretty well. Revenue and EBITDA, 5 to 6% of CAGR. We've seen margins grow almost 500 basis points, 460 basis points of growth, and net profit has seen almost a 14% CAGR. And because of the kind of growth it's seen on a long-term period, we've given it a neutral rating, and it's key to note that Power Grid is a regulated entity, and that's why its returns are usually capped because of the kind of bidding process it goes through when it's getting a certain order. So Harsh, how does the balance sheet look though?
Yeah, I want to quickly also highlight that those return ratios are capped, and therefore you might not see the kind of growth that you're seeing till significant capex is done. Once significant capex is done, it starts to work out. Also, the real-time market, which was RTM as part of our graphics, is also one of the factors that takes care of the return ratio as well. So something that we'll want to keep in mind. But quickly on to the balance sheet. The balance sheet, let me just pull out the total equities, which is around 92,000 crore. It's trading at nearly 3 times price to book at this point. Cash and cash equivalents, not a surprise that it's something a shade lower than 4,000 crore, not a surprise because it's got large free cash flow coming in quarter after quarter. The total debt is 1.23 lakh crore at this point, and the financing cost annualized is roughly 9,000 crore. So your interest burden is around 9,000 crore annualized on a debt burden of 1.23 lakh crore, which goes on to show that your interest expense is not very high, or rather your interest rate on debt is not very high, because this is largely a government-backed company, and therefore it enjoys sovereign rating, and it enjoys its debt enjoys the sovereign related debt cost. So therefore you're largely seeing that debt cost is not very, very expensive for this company, despite it having a very, very large debt. So when you're looking at debt to equity, debt exceeds equity, but at the same time we've given this a neutral because one, it's sovereign backed, interest cost is not very high, and when you're looking at its EBITDA is roughly 30,000 crore. It does a PAT of roughly 17 to 18,000 crore, which is 2x of the interest cost. So it covers interest cost by at least 3 to 4 times if you consider the EBITDA number, and therefore there is that margin of comfort in terms of it being able to service interest cost. The other piece is that it does service its debt as well on a recurring basis, also based on the depreciation it claims, and it's a large component. It claims around 12 to 13,000 crore of depreciation every single year, and that helps the free cash flow to continue to pour in because it's a non-cash expense essentially, and that helps also to some extent to service debt, and therefore are neutral on the balance sheet. But Mihika, on the order.
Yeah, the order backlog or work in hand
Yes.
is how PowerGrid puts it. It's looking really good. They have, as of Q3 FY25, it stands at 1.43 lakh crore. On a quarter-on-quarter basis, there's no growth. But if you compare it to the first half of FY25, which is your Q2 FY25 number, you've seen a 26% growth in the work in hand. Even if you look at how it looked in Q3 of FY24, it stood at 77,000, and that marks an 85% growth in the work in hand for PowerGrid. The work in hand, in terms of 65% of the order backlog or work in hand is currently from new tariff-based competitive bidding projects. Now, this is something where, companies bid at the lowest tariff that they can put up the project and win. So, PowerGrid is even winning this, the projects in this process method where competition tends to be high. And 27 of their order book are from new interstate transmission systems. So, from the work in hand and the kind of revenue visibility it provides for the company, it's looking a thumbs up on this one, Harsh.
Interesting. Let's talk therefore about how the return ratios are stacking up on this one, Mihika. You are seeing anything between 18 to 23% in terms of ROE number over the last 3 years. The ROA number also very, very healthy at around 6 to 7%. The ROC number may be lower, but mind you, this also has a very, very low debt payout, and therefore the debt earning on this would be maybe 7% odd, which kind of caps ROCE, but ROE is very, very healthy in that sense. And that's the real number that shareholders should essentially look for in a company like this, the ROE number. For a PSU company to be at 18 to 23% ROE and having that sustainable, having that firing sustainably for itself is obviously impressive, and therefore it's a good number. Thumbs up on that one.
Yeah, and Harsh, before, what about cash flows? How are cash flows looking like? Because you've seen them kind of turn negative in FY24, but it all depends on their capex cycle as well.
Yeah, correct. Absolutely. So cash flow will always be healthy on this one, Mihika, because as you well know, your profit after tax number is around 16 to 17,000 crore. Yeah. They have around 12,000 crore of depreciation, which they book nearly every year, and that is also a sustainable number because the capital cost is continuously going up, and therefore you have a healthy cash flow. Why the net cash flow is negative? Because they continue to invest very, very heavily in their infrastructure. What they also do is they have a very healthy dividend payout. In fact, till maybe a year or two back, the dividend payout was nearly 6%. Yeah. Of course, the stock has gone higher after that.
It actually increased in FY24.
Correct. So it was nearly 6% at that time, and therefore it has very, very high dividends or a very high dividend payout, which is why you're seeing the net cash flow being negative. Yeah. But otherwise, there is a fairly healthy clip on which the operating cash flow is growing at. If you look at that operating cash flow metric again, there you go. The growth is fairly healthy on this count. So neutral on the overall context of things, but it's a healthy number.
Yeah. Where we do see moderation in cash flows, especially when it comes to something like a PowerGrid.
Yeah, and one thing you may want to keep in mind where cash flows is concerned is how the execution with regard to capex happens. If that were to happen, you'll see this shoot up, and which is what I'll be looking for actually, and that's one of the reasons we've given this a neutral. Mihika.
Yeah, let's go up to your shareholding.
Yeah.
Next, you've seen strong promoter and promoter group holding. It stands at 51%, even if you compare December 2024 to March 2022.
This is government.
Yeah, this is government.
Sorry.
It's fully government.
Kind of,
So when you talk about DIIs, as of March 2022, you had strong domestic ownership, but your foreign ownership stood low, but you've seen a clear growth. There is still some strong domestic institutional holding at 17%, FIIs at 28%, and you also have some retail participation at 3.5%. So from a shareholding pattern picture, it's a thumbs up on this one. And then let's move off to Street Cred. Year to date, the stock is down 6.4%, but there are a lot of other factors that are also coming into consideration. But even if you look at a broader timeline of 1 year, it's not done much. It's 3.2%, which you've seen other power transmission companies do better than that. And in the 5-year period, you've seen growth 214%. And Power Grid has always been talked about. You have longer term projects, so it's going to take longer term to get return. So we've given a neutral in the street cred because you have seen year to date and 1 year performance not do as well.
Yeah, and it's a 3-bagger otherwise.
Yeah.
So your 5-year performance has been fairly healthy. You'll want to wait for execution on this one. Let's look at street coverage very quickly. 17 buy calls, 1 hold call and 6 sell calls. Overall, you have an upside potential of roughly 12%. Of course, you may have to adjust that for today's numbers, and because it's such a volatile day, you might just get a higher return on this one. But broadly, 12% basis yesterday's close is the way we look at this one. Quickly on to how we look at this from a KYC rating perspective. And we'll just quickly sum it up. Income statement neutral, balance sheet neutral, order backlog positive, cash flow neutral. You're seeing return ratios a healthy thumbs up, shareholding a thumbs up, street cred a neutral, and street coverage a thumbs up, and therefore gives it a 6 out of 8 on our KYC ratings. But let's quickly go across. We have our guest to talk to us about Power Grid. We have Rupesh Sankhe, Vice President of Research at Elara Capital, tracks both power as well as cap goods. Welcome, Rupesh. Good morning. Good chatting. First off, I want to understand power demand. And because there's just so much happening around tariffs, I want to understand what the impact could be on something like a Power Grid, especially on the industrial and commercial demand side of things. What is your view on this entire play which is happening in global markets, and what is the impact likely on something like a Power Grid?
We don't see a major impact in terms of power demand is concerned, because in the last 3 years, we have seen the power demand to GDP growth has close to 1.1 times. Historically, the same ratio was around 0.8, 0.9. So we have seen a lot of traction there on the residential side. So residential is close to 25% of the overall power consumption. And in the last decade, we have seen that segment where the demand was slightly slow. But that demand is now catching up. I think the load shedding has gone out completely. So that demand is there. And in terms of the manufacturing or the commercial demand, industrial and commercial demand, we don't see that much impact on the power system demand, because it's largely driven by the domestic production. No doubt, I think there is a market, people are saying that GDP impact will be around 40-60 basis points because of a global trade war, but that will not have major impact as far as the power demand is concerned.
Point taken. Understood.
Investment theme on the green transition is there for next 10 to 12 years.
Okay, so yeah, got it. Understood. Point taken. And how should one view the business sir, in terms of return ratios? They're capped. There's a large transmission requirement, of course, that's there. But how do you view the business with capped return ratios?
Yeah, definitely. See, if you look at the last capex phase, high growth capex phase, was during 2012 to 2018. At that time, we have seen the power transmission capex in India has grown significantly because of integration of all the grids. So Power Grid that time doing close to 30-35,000 crore kind of a capex capitalization. And in the last 3-4 years, we have seen the same capitalization growth has come down to around 15,000, 17,000 crore. And now because of this renewable energy integration, then green corridor phase, I think again, the next 3-4 years, we'll see around 30,000 crore kind of annual capex for Power Grid Corporation. Now the Power Grid has 1.4 trillion of work in hand. That is based on FY27, the transmission opportunities. From 27 to 32, close to 4.9 trillion capex opportunities there. And out of that, close to 3 lakhs is for interstate, where Power Grid has significant market share. Almost 55% market share is there. So if they maintain the similar kind of market share, another we can see around 1.5 trillion kind of work in hand opportunity. So close to 3 lakh crore kind of opportunities there for next 10 years. So on a today's regulated equity, because this is largely TBCB projects. So their ROE will be, as you have rightly pointed out, ROE is slightly lower than the regulated ROE, but the overall equity base will double in the next 10 years. So that is close to 7.58% kind of growth in the equity that we can see. So that kind of opportunity is there. So we are overall positive on the transmission space, because without that integration of 500 gigawatt capacity, or maybe upcoming green hydrogen data center, that is going to be challenging. So this kind of capex has to be there to meet a 400 gigawatt kind of a peak demand by 2032 that we are expecting.
And Rupesh, what should one make of competition? Of course, tailwinds are strong, but how is competition shaping up for a power grid? Can it maintain its monopoly?
So definitely, the power grid has a strong execution capability in the transmission space. So they have that technical capabilities in place. Secondly, if you look at their balance sheet, every year they are generating close to 18,000 crore current profits. So that cash flow is there. Okay. Third, in terms of cost of debt, they are better as compared to other players. So managing better capital allocation, better capital structure, and execution capabilities they have, because a lot of issues are there in terms of right of way, land acquisition. There they are better as compared to other players, and that is what we have seen in the last 3 years when they started entering into TBCB projects. Earlier their market share was hardly 15-20%. That has gone to 60-70%. That kind of capabilities they have. So execution, the technical capabilities they have, the financial leverage they have in terms of managing cost of debt, I think they are ahead as compared to other peer companies. So they are well placed in terms of to grab this opportunity.
And Rupesh, how should one look at cash flow? How much capex are you building in, and how is that expected to be funded? Just give us the way in which cash flow will go about.
Yeah, it's a good point. See, this year we are expecting close to 18,000 crore kind of a capex. Next year it will be around 30,000 crore capex. Even next 3 years we can say a run rate around 30,000 crore kind of a capex. Now, in terms of capitalization, because it takes 3 years to get commission, so capitalization will be slightly lower than the capex. So it will be around 20,000 crore. But if you look at their equity contribution, will be in the range of 75-25, or they might go 80-20 kind of a debt equity ratio. So if you look at the after dividend, they will have significant cash flow for the equity contribution. So we don't see any risk there. Now, in terms of a dividend, we are expecting they will maintain around 8 to 9 rupees per share kind of a dividend. That comes to around 3% at the current market price. So we don't see that risk because of a huge capex there that will have, because they have got a strong cash flow in hand. So they will maintain the current dividend payout ratio. At the same time, they will have sufficient equity for their under construction projects and upcoming projects.
Okay, and your view, what's the largest risk factor to be kept in mind here from an investor perspective?
The risk factor only in case of high penetration of battery storage, because batteries will get installed in the existing transmission assets. So they might not have to go for incurring extra transmission assets. So that is a risk, but we don't see that this is a near-term risk for the battery to get deployed in such a high pace as of now. Second is delays in getting right-of-way issues or land acquisition, or any delays on the renewable energy, because largely capex is coming for the integration of renewable energy with the grid, main grid. So that will have some risk in terms of delay in RE tendering.
Right, Rupesh. And Rupesh, how should you value this? Contextualize the valuation for us. Not easy to value.
Yeah. So definitely, if you look at their valuation band in the last 15 years, they get premium when the capex capitalization trend is on the positive side. So during 2007, 2011, 12, when mostly generation capex was there. That time, this transmission were getting slightly lower multiple. From 2012 to 2018, the multiple has gone up significantly. Now we are also seeing the similar kind of high capex growth in the next 10, 12 years. So definitely they will get a better multiple. So logically, if you look at the returns they are getting from their regulated assets and their TBCB projects, like slightly close to 15-16% ROE is there, and your debt is fixed over a period of 10-12 years. So you have steady cash flows there, and return is there, and you also have a growth associated there. So normally it's better to value based on price to book value, considering the cost of equity, the growth which is there, and the ROE is there generated from these assets. So best valuation tool for power grid with steady cash flows, one-time capex, and you get revenue for next 25-30 years. Best way to value them is based on price to book value.
Point taken. And what's the multiple you ascribe to this, Rupesh? What's the upside?
See, we have positive view on the stock. Upside from the current level is close to 25%. We have given a price to book value multiple at around 2.8x based on FY27, the regulated equity, and overall equity they will get from the TBC. So now their regulated equity as of now is close to 92,000 crores. And based on the 1 lakh crore kind of capitalization they are doing in the next 3 years, we can see around 30,000 crore kind of addition in their existing regulated equity. Over that, we are giving 2.8 times market cap to equity, considering they will maintain 15.5% kind of ROE on a consolidated basis. And the growth will be around, earning growth will be around 9.5%. And the capex growth is, they will maintain 55% kind of a market share in the upcoming transmission opportunity from 27 to 32. So that way, we have arrived at value of around 350 rupees currently. Our fair value is 355.
Okay, point taken. Thank you so much, Rupesh, for coming in and speaking with us with regard to this one. It's a well-tracked counter, and it's a Nifty 50 stock, so wide interest in that sense, and also slightly insulated from tariffs. Interesting one, but hope this has been helpful. From Mihika, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.
That's huge. That is a biggie. It's on.
गोल्ड ग्लास क्लियर ग्लास, कार हो या नियर, सब कुछ दिखे क्लियर.
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
SEBI is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Thanks for tuning into this special conversation, and I call it special because we are trying to not just gauge at what the equity impact is, and it is looking very bad because the markets are roughshod today across the world, and in India no exception. But we're trying to kind of take a look at what lies ahead, and to do that, Sonal Verma, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura, joins in right now on the show. Sonal, thanks so much for agreeing to talk to us. It's a pleasure talking to you today.
Thanks, Neeraj.
Sonal, just starting off with, how have you gauged the economic impact of this tariff war on India? If I can start off with that. I'm not calling just the economic impact of the tariffs, because everybody's saying that India is not as impacted by tariffs, but there could be an indirect impact due to supply chains, due to currencies, and a lot more.
That's right. So I think the direct impact is probably easier to estimate, given India exports about 2.2% of its GDP to the US. So we know that there's probably a 20 to 30 basis point kind of a direct impact. But I think this is much bigger than that, and that is where the concern really is. It's really the weaker global demand, uncertainty weighing on investments, tighter financial conditions, which basically feed back into weaker business investment, and also hurting consumer demand because of the negative wealth effect. And actually, the second round effects are extremely difficult to quantify and are still playing out as we speak. So our growth projection for FY26 is at the low end of consensus. We think growth will be softer the ongoing financial year at 6% on a year-over-year basis. But we do see downside risk even to this projection. And globally, Neeraj, we've cut our numbers more significantly for other open economies in Asia, and for the US as well. We've downgraded our growth numbers for 2025.
That was going to be my next question, that would you reckon that global growth at large, as it stands, takes a significant cut on current scenario? And does that, Sonal, change meaningfully? Let's say growth for the ASEAN region, does it change meaningfully if economies are able to strike some kind of a deal with Donald Trump? Because everybody at least in Asia and Australasia, maybe, Australia, Japan, Vietnam, all of them are on record saying that they want to go to the US, talk to Donald Trump and try and reach a deal.
That's right. I think outside of China and EU, at least most of Asian countries are looking to negotiate with the US rather than retaliate. And this negotiation is either in the form of lower tariffs, more investment in the US, buying more of US goods. So a lot of countries are offering that. The question is, the reciprocal tariff is actually not just about lowering tariffs. And for instance, the VAT or the GST that countries charge this is an important source of fiscal revenue for these countries. and therefore it'll be very difficult to negotiate on the GST rate, for instance. Similarly, the tariff on politically sensitive sectors like agriculture is potentially non-negotiable in a number of countries. So I think it is possible that some countries do manage to negotiate their tariffs slightly lower going forward. But even countries that actually have basically an FTA with the US have been slapped with a 10% tariff. So the extent of rollback on tariff is possible, but may not be very substantial. And therefore, our assumption for the US is that US effective tariff rate on its import will be above 20% this year. And if the US wants companies to invest in the US, then they will likely keep tariffs high for some time. So the tariff rates will also be sticky. So some rollback is possible, but I mean, I think, it may not be very substantial is what I'm saying. Now, I mean, what it means in terms of global growth, nevertheless, is that the tariff shock is quite significant, both directly as well as indirectly through the various channels that we discussed. Particularly for the US, it is a stagflationary shock, and we have cut our growth projections for 2025 for the US. So on a Q4 over Q4 basis, we've cut our numbers to 0.5% up, down from about 1.4%, so nearly a percentage points drop. For rest of the world, it's more of a negative growth shock as well. So for Europe, Euro area and Japan, we've cut our numbers by 0.2 percentage points. And Asia, we think, will be hit the hardest because this is basically home to the open economies in the region, and the tariff rates on Southeast Asia are quite elevated at between 35 to 50%. So the growth impact will be quite substantial for countries like Vietnam, Thailand, Singapore, Korea, Taiwan. So we've made cuts anywhere between 0.3 to 0.6 percentage points across countries.
Okay. Do you anticipate, Sonal, this to become a global trade war? And the reason being that maybe China's share of exports which were going to the US, if they don't go in the same velocity, do they get dumped in other countries? Do we see other countries erect those trade barriers in order to protect their domestic economies? And therefore, does this have the probability of escalating into a full-blown trade war? Even if countries don't want it, they might have to do it.
I think that's the risk everyone is quite worried about. In the first phase, it's really the friction between US and rest of the world. We have seen a more aggressive retaliation from China this time around with the 34% tariff on all US imports. This is more aggressive than what we had anticipated. And we know that the EU is working on some kind of a retaliation package as well. And President Trump has threatened to retaliate against any retaliation. So, how this itself plays out between US and rest of the world, and particularly China and Europe, is something we basically need to monitor right now. And second, and sort of the phase two is what you're referring to, which is that with the higher tariffs on China and a number of other countries, there is this excess supply of products that is now available, and which will look for newer markets outside the US. And so we could see more influx of goods coming through into different countries, which could be a disinflationary force, particularly for goods prices going forward. And countries ultimately may end up wanting to protect their own local boundaries in terms of protecting local factories, protecting local MSMEs, the jobs in these countries. So we could see more anti-dumping duties and safeguard duties getting imposed by some of the other countries as a result of this redirection of trade. So I think no one wants a trade war. But right now, that's basically a risk that we're all watching.
The hypothesis that you may have built, either in your mind or in your notes, Sonal, does it have a parallel in history?
I mean, the 20+%. So actually, let me take that back. So we have actually had one of the more hawkish assumptions on US tariff. Our view was that President Trump would follow through on his threats, and we had assumed that the effective US tariff rates would go up from low single digits to 14%, which was one of the highest on the streets. What we've got is above 20%. So it's actually worse than what we had anticipated. So this is the highest tariff rates we've seen in basically 100 years. When we look at either the Smoot-Hawley period in 100 years back, I think that's basically the environment that we are looking at, where countries are becoming more protectionist, and that typically leads to material slowdown in global trade and breeds more protectionism, more inefficiency across countries. And given particularly the role of supply chains in the last 50 years in boosting efficiency and lowering the cost of production across countries, this is actually more inflationary over the medium term, even though near term we are talking about the disinflationary force because of these trade frictions. So we really need to go back 100 years to look at what this new world order means.
Well, one certainly hopes it is not akin to the Great Depression 100 years back. Incidentally, viewers, if the S&P 500 were to correct by 4% today, then it will be the first time since then that it will have 3 days of such a steep correction as well. Sonal, I'll come to central banks in just a moment, but before that, one quick word on the currency. Somebody expressed this opinion that there is, we know that China is trying to defend the yuan in a meaningful way because they want to avoid the capital flight, gain investor confidence, etc. But what if due to compulsive factors, including competitiveness, they devalue the yuan? What happens then? One, in terms of, it's an act of kind of an economic act, and what happens to, let's say, economies like India in the result of that, or for the currency of India, for that matter?
I mean, our view is China is not going to go down the devaluation route, purely because the cost of the devaluation domestically to China in terms of aggravating capital outflows, hitting the property market, worsening confidence within China, the costs are much, much higher than any benefit to China on the export front. So we don't think a devaluation is likely. What can happen is, some drift higher in the renminbi. But that'll be modest depreciation, not a sudden devaluation. Now, in the scenario, and just to put this in perspective, during the first Trump war, we did see China actually adjust its currency a lot more steeply, and that offset some of the higher tariff impact on US consumers. This time around, because we don't think there will be such a massive currency offset, and because Trump has basically put a tariff on most of the other countries, the ability for US to actually substitute its imports from other countries is actually lesser than was the case during the first Trump administration, which is why we think the inflationary impact on US economy this time around will be much, much higher. Now, in the hypothetical scenario where China does devalue the currency, then essentially that will put pressure on rest of Asia as well, because there are product segments in which a number of Asian countries compete with China, and that will trigger some sort of a competitive devaluation or depreciation within Asia. But as I said, we're not expecting that in our base case.
Some relief. I mean, we're shuddering what could happen if indeed China does that, and what music unfolds after that. Okay. Now, Sonal, two other questions around central banks. Firstly, while Donald Trump urged Jerome Powell to quit playing politics and cut rates, Powell has come out and said that they are still wait and watch. But I'm asking you that in the event that the chances of a recessionary feeling, if not an actual recession in the US, were to go up, some statistics suggested some 67% number overnight. Will the Fed cut rates, or will inflation in the US because of the tariffs force Fed's hand to not cut rates even if growth were to come off the way you are saying it would?
Yeah, so, if you look at Nomura's base case, we have growth, as I said, coming down to 0.5% by Q4 this year, which is a fairly steep slowdown, but we're not forecasting a recession. Meanwhile, the inflationary impact is also important. So we think core PCE by the end of this year will be close to 4.6%. So growth is below target and below trend, rather, but inflation is also 2 times the 2% target that the Fed has. So if we have this combination where growth slows but does not actually slip into a recession, then we think the Fed is going to focus more on the inflation part of the mandate, particularly because we're coming from a period where inflation has actually been significantly higher than target for a long period of time. And it's taken a lot of policy effort to actually bring inflation expectations back down. So if you see another significant, price shock, the spillover of that on inflation expectations can lead to more material unanchoring of expectations over the medium term. And that part of the mandate is what we think the Fed is going to focus on. So our base case is that the Fed is going to stay on hold both in the second and the third quarter of this year, when the peak of the inflationary impact of the tariff is playing out. We only have the Fed beginning to ease policy towards the end of this year, when the peak inflation, the peak price effects have played out. That is when we think the Fed will start focusing on the growth or the unemployment part of the mandate. So despite our view of weaker growth, we actually have the Fed on hold for now. Now, obviously, things are extremely fluid, Neeraj, and I think the non-linear effects that we are talking about in terms of uncertainty, business investment, confidence, financial conditions, wealth effect, consumer demand feeding back to the labor market, feeding into investment, jobs. So these non-linear effects, if they were to trigger a more significant recession in the US, which is not our base case, I think in that scenario, probably the confidence around the pass-through of higher prices into second-round effects, that risk would be much lower because of a significant demand-side effect, and probably the businesses will take more of a hit on their profit margins rather than pass it through to consumers. In that environment, we could see the Fed step in and deliver rate cuts. But again, it depends on how big of a growth shock we see as a result of these tariff increases.
No, completely understand, Sonal. I mean, for all you know, the view may be different tomorrow. I mean, 24 hours can't be too long in such a scenario. So completely agree. Don't envy your job at all right now. Sonal, while that is your view on the Fed, and assuming that's how it plays out, does it force the RBI's hands to do something different? Or does the stability in rupee, inflation, growth, etc., lead you to believe that the RBI will cut now and ahead?
I think RBI will cut now and ahead. And, the macro backdrop is very, very different for central banks like the RBI. So unlike the Fed, which is facing, this dilemma of higher inflation, lower growth, I think it's a pretty clear-cut low growth, low inflation environment for countries like India. And the drop in oil prices, Brent, between $60-65 per barrel is a fairly significant disinflationary force, the impact of which we will see in the coming months. So, relative to whatever we thought 2 months back when the RBI met in February, there are downside risks to both growth and inflation. And inflation was already tracking close to the RBI's 4% target. So that is one. Second, I think the currency side as well. I mean, what we've seen is actually dollar weaken, in the last few days. vis-a-vis the typical strong dollar during a risk-off move we have seen. And when you have weak exports and you have low inflation, then some sort of a rupee depreciation is par for the course because it becomes a shock absorber. And in India's case, we have very limited fiscal room to actually support growth. So when you have such a major external development playing out, you basically need domestic demand. You need policies to basically support domestic demand. And given the limitations on fiscal, I think monetary policy, liquidity policy, macroprudential policies, a combination of all three will need to be used to basically, try to support domestic demand and offset the negative spillovers we are seeing and we are going to see on exports, which will spill into investments as well. So I think the room is clearly there, and we don't see any hurdle for the RBI. They've been extremely proactive on liquidity, which is a very positive move. It will help in policy transmission. It will help compress some of the spread widening we had seen in the last 3 months as well. And the policy transmission of the upcoming rate cuts should also get accelerated. So we are still expecting 5.5 as a terminal rate, which is another 75 basis point more to go.
Sorry, but I just take one last question out here. We've been trying to talk to foreign institutional investors about their view on India after the corrective move that happened all through November, December, Jan and Feb. Just trying to understand, as you talk to your clients on the back of all the action that the government took in the budget, but more importantly, as you said, the proactiveness of the Reserve Bank of India, are clients sounding a lot more confident in India's ability to, support growth in the country, both the RBI and the government?
I think right now everyone's just trying to figure out what these Trump tariffs mean for the world. But I think on a relative basis, it is fair to say that India is seen as less vulnerable because we are less exposed to exports. We have been very proactive in terms of negotiating with the US on the bilateral trade agreement. So actually the reciprocal tariff, while high, is not as high as what some of our competitor countries have seen. The lower oil price is a positive for India. And India is still seen as a relative beneficiary of the supply chain shift. So our view is the 46% tariff on Vietnam, for instance, vis-a-vis the 26% on India, plus the fact that India is a strategic ally of the US, does mean that over the medium term, India is going to be a relative beneficiary of the supply chains that are moving in the low to mid-tech manufacturing sector. And as you said, I think we are seeing a lot more proactive policy easing kick in. So there is downside risk to growth, but there are also some offsets and compared to some of the more open economies. Therefore, India does look relatively better off in an otherwise what looks like a very, very difficult external environment.
Yeah, I mean, to say the least, but Sonal Verma, understand this completely. Thank you for a complete lowdown. Really appreciate you taking this time and talking to us today.
Thank you very much.
Wow, so helpful to talk to somebody who just crystallized everything for us. I hope this was beneficial, viewers, for you. And actually, let's take that point a bit further to understand the impact of tariff on autos. My colleague Puneet spoke to Jonathan Starks, CEO at FTR. Listen into what FTR is making out of the rattled global supply chains.
The very first impact is more limited than what could have been in place. The fact that Canada and Mexico were not implicated in the initial set of reciprocal tariffs meant that some of the impacts that could have been most severe for the sort of the domestic North American Class 8 marketplace were less severe. But there are still some pretty significant impacts related to steel, iron, aluminum that are definitely going to be a negative overall when we're talking about the equipment marketplace, and the fact that we're going through so many disruptive events, whether it's the reciprocal tariffs or what's happening within the North American space with US, Canada, and Mexico that is going to disrupt the freight transportation markets, which is really what drives the demand for equipment. And if we are losing the ability to grow in the freight transportation space, doesn't matter what the cost implications are going to be for new equipment, we're going to lose demand for building that equipment.
Well, that's definitely going to be stuck, sir. But I just want to understand and take this point forward for tariffs, essentially, that now that we've seen not any kind of additional tariffs coming for Canada as well as Mexico, but we see a lot of Indian forging companies essentially have more than 30 to 35% of their standalone revenues to the Class A truck market. So apart from these countries of Canada and Mexico, how are you seeing the kind of impact currently from these players across India as well as Europe to the US Class A truck market?
The hardest part about all this is that we really don't know, because even though everything has been stated now, we sort of have a baseline we're working from on what the reciprocal tariffs are. Now we're down to a negotiation phase. And so that means that what we see right now could be radically different from what's actually going to be implemented in place here over the next few weeks or few months. So it makes for a very disjointed picture. It's very hard to give a good concrete answer on what this is going to do for the marketplace, which is unfortunate because we would love to be able to give more clarity. But I think what it does highlight is the fact that we're in this period of uncertainty that is going to dampen demand overall. So whatever good positive benefit any country might get from having a better tariff environment relative to China is probably going to be mitigated to some extent just because we're going to be reducing demand in the marketplace.
Now, Mr. Starks, I just wanted to ask you, over the last 6 to 8 months, starting somewhere around September till March, the preliminary figures, of course, it's been a high single-digit drop in sales essentially over the last 6 to 8 months in Class A truck market. Could you, just quantify some of the factors that might be impacting due to this? Because we've seen that, fleet utilization have also been lower in this particular time frame, and that's not leading to incremental sales, of course. So what are some of the key factors that, according to you, have been impacting the market over the last 6 to 7 months?
Well, we've been in an extended freight weakness for nearly 2.5 years in the U.S. market. And it's always freight that drives the fundamental demand for equipment. And so the fact that we've been in this weak environment for so long, we knew that we were coming to a spot where we were going to get a weaker environment for new equipment demand. And we're finally getting to that point. The negative downsides of what we're seeing right now is that weakness could be persistent for a much longer period of time than we would have anticipated that we would have seen going into the start of 2025.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which
runs at 2:30 p.m. every day.
He sold most of his stock, 80%.
Hello and welcome to our special programming on US tariff wars. What does this mean? Because stock markets across the world are falling on the back of Trump's tariffs and increased fears that the world's largest economy, the US, could go into recession. In fact, some experts say invest in the markets now since the valuations are cheap. Others say sit tight on the sidelines and wait for this to play out. Yet others say that you should move your money out of equities. Now, in this confusing situation, it is natural for investors in India to be worried about what they need to do to safeguard their money. Uncertainty is perhaps the most difficult scenario to tackle, and because no one really knows what's going to happen, there are estimates and guesstimates galore. At NDTV Profit, we're asking the questions that many of you have and provide you with sound, recent advice from the best of the experts. For many of you, this is probably the first market fall you're witnessing. Panic will not help you in any way, so we urge you to keep calm and weather the storm and keep watching NDTV Profit to get the best advice on how to be resilient in these trying times. In fact, we will get you market voices who tell you what to buy, what to hold tight, and what you should be doing. First up, we have the focus that's coming in terms of domestic consumption theme for the next 2 quarters. And this is what market expert Nischal Maheshwari said on the current market situation. He added that there's no point in selling in the kind of market that we are in. Let's listen into a bite of that conversation.
Yes, it's been a turbulent morning, basically. Yes. At the moment, I think the best thing to do is just stay away from the market. There is no point on catching a falling knife because you really don't know how the other countries are going to react. China has already done it. Other most countries, smaller ones, basically have all come to the table to negotiate. So let's see how all this pans out. I think it's best to avoid for next 1.5 weeks. See how all these things pan out. Maybe the Nifty will go to whatever levels. Nobody can predict that. So best to avoid. There is no hurry to buy in this market.
To buy, but then would you avoid selling as well, Nischal? Because the point is that, and here I'm talking about something like a trend. Okay, so there was a business update that perhaps was not as rosy as some would have liked, but 28% growth in the revenue for the fourth quarter. It was expected of over 35%. It's a stock that is down 17%. It's a Nifty 50 stock. Do you avoid selling as well is a question.
So it depends upon basically whether it's been selling because there has been some margin calls. If there is no margin call, I don't think so. At this point, basically, not only trend, but anything. There is no point in selling in this kind of a market. The markets are very low. I think some sane sense is going to come back to this market and maybe you will get better rates basically to sell.